Well, good evening, everybody. Depending on where you're dialing in from, I'm dialing in from the East Coast. So it's 7 minutes after or 5 minutes after 7 o'clock. And I know we have people in all the different time zones here. And I'd love to just see, Gabe, you've already started. So if everybody wants to type in the chat, where are you at right now as you're watching this live event? I would love to see where everybody is. So we have somebody from Hawaii, Houston, Texas, Dallas, Boston, Arlington, LA, New Jersey, Utah, Dubai. Wow, that's amazing. Boise, Chicago, Washington, D.C., Southern Cal, Vancouver. Man, I can't keep up with it all. Atlanta, Phoenix, Salt Lake City, Flower Mound. That's Dallas, Columbus, Pennsylvania, Utah, Newport Beach, sunny LA, San Antonio, Florida, Toronto. All right. Well, it's great to see that we have truly an international crowd tonight, spanning multiple time zones and multiple continents. So that's really, really exciting. And I'm especially excited about tonight. Many of you know, for probably the past decade, I have done what's commonly referred to as an apartment investor forecast, where I also reveal the top markets for apartment investing and apartment performance. And I'm going to do that tonight. And what I do is, I study and subscribe to a lot of the top research that's available for apartments. And that includes research from companies like Marcus and Millichap, CBRE, Berkadia, Cushman, CoStar, Yardi, lots of different companies. And most of you know me. Maybe some of you are hearing me for the first time. And if you're hearing me for the first time, I'm an engineer with an MBA before I got into real estate and apartments. So I'm kind of a nerd at heart. And I love data. And I love charts and graphs, and I love spreadsheets. So we're going to go ahead and kick things off. And in a few minutes, I'm going to share my slide deck, and I'm going to start things off. But I have two really special guests on tonight, and I'd like to introduce them. And I'd like for each of them to, when I introduce you, John and Robert, to just, do a brief introduction of yourself for 60 seconds. And then it'll swing back to me, and I'll do a brief intro, and then I'll bring it back to you guys. So the first special guest is John Chang, and I've known John for many, many years. He's a top executive at Marcus and Millichap, and I believe his title is Chief Intelligence Officer and Research and Analytics. And he does a lot of the research that I personally use to make investment decisions. And every year his company puts out a annual multifamily investor report, and they cover economic trends, capital markets trends, and they have a top 50 they study the top 50 largest metros in the United States. And John, I just picked this up when I saw you last week in Las Vegas. So if you just want to, for a few seconds, just talk about why you're excited to be here tonight and what people could expect from your presentation.
Fantastic. Thanks, Brad. So I'm John Chang. I run research and analytics for Marcus & Millichap, which is a leading commercial real estate brokerage company. And one of the things we try to do is provide insights and information to help investors make better informed decisions. If we can help investors create and preserve wealth, then we're doing our job. And as Brad said, we've gotten to know each other over the years. I've spoken at a couple of his events, and so I'm excited to be here and share some insights with everybody.
Yeah, so you guys are definitely going to want to stay on. And John will be speaking right after my short introduction. And my other special guest is also a good personal friend of mine that I've known for about a decade as well. And his name is Robert Helms. And Robert is known for having one of the largest, most watched, most listened to, most downloaded real estate podcasts called the Real Estate Guys Radio Show. And Robert is just full of information. He has a lot of contacts, goes to a lot of events, has proximity to people like Kenny McElroy and Robert Kiyosaki, and also people that are outside of real estate that are, heavy into different types of investing. And so later on, after John is finished, Robert's going to give us some of his insights into what he's looking at for 2026 in apartments, but also maybe in some other asset classes. Robert, so remember, I'm going to ask you that question. What other asset classes you're bullish on? So why are you excited to be here tonight? And what are you going to be sharing with everybody?
Well, Brad, it is a pleasure to be here. As you know, at the Real Estate Guys, we have pointed to this exact event, your forecast that you do every year. And this is the first time I've been on as a guest. So I'm thrilled to be here. I would be watching it anyway, because every year you bring such great insights into this. And I think right now, folks are a little concerned with things that are going on in the world, with the headlines, with all that. And I think tonight is about really looking at the data, where things are headed and where there is opportunity. There's always opportunity. I think folks will be pleasantly surprised about where they can get their hands on some of that. So I'm thrilled to be here and can't wait to hear from John and to hear what you have to say.
All right, amazing. So I'm going to go ahead and thank you, Robert and John, for being here. And of course, thank you everybody from all over the place that's watching live. And also those of you that are not watching this live, but are watching the recording. And I know there's many, many hundreds more that have registered that are not personally on tonight. So appreciate you watching the recording. So I'm going to go ahead and share my slide here. Want to make sure that everybody could see that. Ivy, I know, John, you can, okay, good. So of course, we all know who's on and what we're going to be talking about tonight. So over the next 75 to 90 minutes, and many of you have been tuning in to me monthly, pretty much, where I do some sort of free content around multifamily investing. And I like to keep those to an hour. Tonight, it's going to go a little more than an hour because of the nature of the content being presented tonight and the two guests that I have on. And so I want to let you guys know that this one will go probably close to 90 minutes. Okay. So hopefully you've been able to create or will be able to create that time to stay on, because you're not going to want to miss a minute of what we're covering. So after my brief introduction, John Chang is going to give us his update on the economy, capital markets, and multifamily investing. And then Robert is going to share some of his insights. And one of the things that will happen, John, when you're done, is Robert and I will also kind of debrief it, and hear from the audience. And I know you're not going to be able to stay on for that. And then I have some other data that I've been able to pull from some other research reports. And so what I'm going to do after John is try to put it all together, okay, and see where we're at for 2026. And then I'm going to share with everybody my time-tested, proven recipe for selecting great markets. And I know y'all are waiting for my top 10 market predictions for 2026. So I'm going to be revealing that. And then one more thing before we finish is I really want to dial into, and it sounds overwhelming, but I'm going to give you the big picture on one slide. Okay. On one slide, I'm going to give you the big picture of the 18 steps. These are the 18 things you need to be doing to investing in apartments successfully. And then I'm going to also remind you about how anyone could get started. So this is what's going to be happening tonight. Okay. So my personal introduction, by the way, is there anybody here that has never seen me present before? If you have not seen me present before, I would like for you to type it in the chat. And, maybe everybody has seen me present before. So I'd just like to get that information. So let's see. So Bonnie, Hamilton, and Tammy, and Ricardo. So there's at least 3 of you that it's the first time. So does that mean that everybody else has already seen me present, or that you don't want to type in the chat? Okay, there's a few more of you. So I'm going to make this introduction pretty quick, because it occurs to me that most of you have heard me speak before or have done a Zoom meeting with me. So look, when I started, I had an engineering degree and an MBA. Never thought I would be a real estate investor. Lost my job not once, but twice over 14 years. And I picked up Robert Kiyosaki's books. And I ended up finding myself in the most unlikely place that you would see me 24 years ago. And that was a real estate investing seminar, of all places. And I sat there for 2 days. And day 1, I was very skeptical. And day 2, I was taking a lot of notes. And they offered a mentorship program, and I actually bought it. And 8 months later, I bought a 32-unit building with no previous experience. Since then, I've done over 11,000 units. So many of them, I need to update this. Probably half of them now have went full cycle. Haven't paid federal tax in a long time because of the tax benefits due to apartment investing. And because I started by going to a seminar, I started doing my own seminars. And so I started mentoring and coaching people as well. And I became really passionate about it. So the people that I've coached and mentored, I refer to as students. And they've bought, this needs to be updated. I think it's over like $10 billion of total purchase volume and over 850 apartment buildings. So, and I've been in the business 24 years. So a long time. That was my first building. It was a 32-unit building. That was my second building, a 30-unit building. And then my third deal was a 250-unit syndication. And then I've been syndicating deals pretty much ever since. So I've been doing this now, actually 24 years, done a lot of deals, made a lot of money, made a lot of mistakes, learned a lot, helped a lot of other people. And by the way, I've been through 2 downturns. You know, Ray Dalio, the billionaire hedge fund manager, I got the privilege of hearing him speak several times at Tony Robbins masterminds that I was a part of. And Ray Dalio taught me that every asset class, no matter what it is going to go through a downturn every 10 to 15 years. And that's been true in multifamily. You know, I started in 2002. And there was a pretty rough downturn in 8, 9, and 10. And then it went really good. And then there was another downturn. And now it occurs to me, based on the data, and we'll hear what John has to say, but it occurs to me that we've kind of hit the bottom. I mean, are we at the absolute bottom? I'm not 100% sure. Nobody is. But it occurs to me we're really close to the bottom. Okay. And I've invested a lot of time and a lot of money in my own personal development, going to seminars, masterminds, and mentorships. And so that's just a little bit about me, okay? My company mission is big. It's to impact millions of people and help people become financially free by investing in apartments, following a proven system that I continue to perfect over the 24 years that I've done it. And I'm passionate. I have some A-class properties, but I got to be authentic with you. I'm really passionate about buying the B and C communities, because this is where the working class people live. And I just believe that, if we could come in and make money and also make an impact and provide clean and functional housing to working class people, that we're doing good at the same time as we're making money. So that's a little bit about me. And I'll begin with the end in mind. I'm going to invite everybody to my next training event. Okay. I normally save this for the end, but if you want to learn my system, you get to come for free to Dallas in March. Okay. And what I'm going to teach for 2 days is how to find deals, how to fund deals, how to close deals, how to operate deals, and how to exit deals. Okay. There's no other speakers. It's 16 hours of content. I'm the only teacher. And I'm going to let you come for free if you apply. Okay. And I personally review the applications. Okay. So that's the deal. That's what I was going to save to the end, but I'll put a bigger QR code in there. So I would love for you to come if you want to learn what this is not. This is not an industry networking event. Okay. This is not like, hey, I'm going to be in the hallways, in the coffee area, building my investor list. This is for people that want to learn from me. And I'm going to be teaching you step by step, ABC 1, 2, 3, from the beginning to the end and everything in between. Okay. So if you want to come, you go ahead and take that picture and fill out the application. And I'll let you come to my event in Dallas on me as long as you're qualified. So that's my introduction. And John, do you want to take over? Let's go back here. I screwed that up. So John, this is your first slide. And I'll let you take it from here.
All right, we're going to take it over. Fortunately, I have someone to help me here. All right, looks like we got it up. Okay, so, Brad, I want to see your top 10 list. So make sure to send that to me. I'm not going to be on for that part, and I want to see it because I want to compare notes and see what you think, because the investor on the street, like Brad, really has their nose to the ground and can dig up things that I miss. So I'm very curious what that looks like. But as Robert said earlier, there are a lot of concerns. And that's probably the single biggest challenge that we have right now. There's so much uncertainty out there. What happens with the Federal Reserve? What happens with tariffs, AI, Greenland, Venezuela, ICE enforcement? All of these things are capturing the headlines and dominating our mind space and really creating challenges for businesses and investors in making decisions, because when there's so much uncertainty, it really causes people to be more cautious. So if you look at this slide, this is called the Uncertainty Index. It's an index created by a couple of professors, one from Stanford, one from Chicago, and it has been a fantastic measure of the uncertainty levels in the economy. And again, it's reflected in the performance of different facets of the economy. So you go back in time and you remember the pandemic, there was a lot of uncertainty then. But during the announcement of the tariffs, the Liberation Day tariffs, the uncertainty index spiked to a whole new level. And it has since come down. But again, in the last month or so, it bounced up again as we've been dealing with geopolitical issues, trade tensions, fiscal gridlock. We just had another government shutdown. It was only partial, but we still had another government shutdown that's, pushing back some data releases and so on. But this is a climate in which it's very difficult to make decisions. So despite all of that, we still see the economy growing. In fact, the third quarter had fantastic growth. It was north of 4%. Going into 2026, the expectation from leading economists is that we will have 2.1% economic growth. Goldman Sachs is higher than that at 2.8%. Morgan Stanley's at 1.7%. But the point is that the probability of a recession at this point is pretty limited. I was talking to Mark Zandi at Moody's the other day. We had him on a webcast. And he's saying, well, maybe 35% probability or risk of a recession in the coming year. There are things that could set that off. But if none of those issues emerge, then more than likely we're in for 2% economic growth. A big piece of that is data centers, but consumption continues to run strong. We're seeing strong retail sales. We had good holiday sales. So overall, the economy remains sound and it continues to perform despite all of that uncertainty and the caution it is creating. Now, one of the places we are seeing an impact is job creation. So last year in 2025, the first 4 months of the year, January through April, we averaged about 140,000 jobs per month. After the tariffs were announced, since May of last year, job creation has only averaged 11,000 a month. So we had a real pullback in the pace of hiring. We're forecasting only 300,000 jobs for 2026. But remember, that is positive. That is not job losses in net. In net, we will continue to create employment in the US in 2026. Now, the unemployment rate has been bouncing around. It's around 4.4% right now as of the last reading. That is still historically low. You know, there have been changes in labor force participation. There are other issues out there that are also restraining the labor force. But in net, the employment market still remains sound, but we're not creating as many jobs as we have been. And as a result, that's going to weigh on new household formation in a lot of markets, which means that the demand for apartments is slowing down. But as Brad mentioned, there are cycles, and this cycle too will come to an end, and we'll start to see household formation rise again, and I'll speak to that a little bit later. So when you look at the markets across the country, Dallas-Fort Worth was one of the top job creation markets for the last 5 years. And if you look at Texas as a whole, that's been driving a huge amount of employment growth. Same with Florida. This last year, it really got shaken up a little bit. Philadelphia, which has never been at the top of this list before, was the top job creation market in 2025, followed by Charlotte and Chicago. Those are markets you don't ever see up there, but they have been really sturdy in the face of the headwinds that we've been dealing with. So they're outperforming right now, and that's showing up in the apartment data as well. But there's really kind of a dichotomy. You have the Sun Belt markets where we had a lot of development, and then you have the non-Sun Belt markets, which are slower and have been I kind of think of it as a tortoise and the hare, right? So the hare or the rabbit markets go fast, but sometimes they get distracted. And then the tortoise keeps plowing along, and sometimes one gets ahead and sometimes the other. So that's where the employment has been. The other thing that we've been talking about a lot over the last year, 2 years, actually the last 5 years, has been inflation. And we had that huge spike in 2022, and that drove the Federal Reserve to raise interest rates very fast in order to control inflation. And Brad mentioned there's been a couple of downturns that he's been through. And that was the thing that drove that downturn for commercial real estate in 23, 24, 25, which was the rapid increase of interest rates. Commercial real estate, multifamily, is dependent on debt, which is a huge opportunity and huge advantage. But when those rates shot up so quickly and stayed high, that created some challenges. Now, inflation has stabilized. It's ticked up a little bit over the course of this year, but the expectation is that inflation will not rise too severely in 2026. I'm talking about somewhere around 3%, and that's because of the way they measure inflation. Housing inflation specifically is going to help restrain the overall inflation rate, keep it near 3%, and that's going to free up the Federal Reserve to continue to lower rates this year. So we just had 3 rate cuts. That brought down the overnight rate. The expectation is another 1 to 2 cuts by June. And for the full year of 2026, we should have 2 to 3 cuts. Now, we do have Chairman Powell ending his term at the Federal Reserve as the chairman on May 15th. Kevin Warsh has been tapped. He's the presumptive new chairman, and the question will be, where does he go with the Federal Reserve and how does he lead it? And remember, there are 12 voting members on the Federal Reserve Board that make the rate decisions. So it's not just one individual. There is a whole group of them combining their insights and information to make those decisions. But if inflation stays down around 3% or lower, then they're going to have some latitude to reduce rates and potentially boost the hiring outlook in 2026 and 2027. Now, there's also the 10-year Treasury upon which a lot of the debt is structured for commercial real estate and multifamily. That is kind of doing its own thing right now. Traditionally, they tend to move together, but not in lockstep. So we'll have to wait and see how the 10-year Treasury moves over the course of 2026. So I'm going to shift gears out of the economy now and talk a lot more about multifamily and what's happening and what we're seeing in the market, what some of our predictions are for the coming year. And one of the things that has happened over the last several years, we had an enormous influx of new supply added to the market. They were building at a rate we haven't seen in 30 to 40 years. And so more apartments were added very aggressively, and the peak of that cycle was in 2024. Now that's the blue bars here. The orange bars are net absorption. That's how many net new apartment units were filled. So even as we were adding an enormous number of apartments across the country, predominantly in the Sun Belt, we saw absorption, demand for apartments rise and actually exceed the level of construction in 2024. Last year, we started to see it taper. And in the second half of the year and in the fourth quarter, absorption did run negative. So that's a reflection of that slowdown in job creation. In order to create a new household, you have to have people, they have to get a job, they go out, they form a new apartment household, and that fills those apartment units. So we have seen a slowdown there. And we are predicting in 2026 that construction will taper, but we'll see absorption come down a little bit more. So we're expecting vacancy rates to come up just a bit in 2026. So when you look at the next slide, you can see that the vacancy rates for different property types, different classes, the top tier, newer Class A properties compared to the Class B and Class C, which are traditionally workforce housing. And you can compare the Sun Belt versus non-Sun Belt markets, and you can see the impact of all that construction on the Sun Belt. Now, even though those are new apartments, the vacancy rate of the Class A did not go up as severely. That spread didn't widen as much as you see in the Class B and Class C. And that's because of the cannibalization. Basically, your Class A apartments came into the market. They offer concessions and opportunities and reduced rent to fill up those new units. And the person living in a Class B apartment moves into the Class A apartment for a year. And then the Class B owner looks around and says, shoot, I'm losing tenants to the Class A buildings. And then they do the same thing to the Class C. So the Class C apartments in the Sun Belt have a very high vacancy rate compared to their historical norm. And you can see in the non-Sun Belt markets that that gap is not the same. And actually the Class C have a lower vacancy rate than the Class B and Class A. So this is a temporary situation that is causing some challenges for some of the owners and operators in the Class B and Class C space right now. When you look at the construction starts, when I say it is coming down, it is a significant drop-off. We're seeing a 72% decrease in multifamily starts, and the number of units under construction is down by 52% compared to the peak in 2022. So basically, we're on the backside of that wave. Those new completions, those new apartments that have been creating some of the shockwaves through the multifamily market is abating, and we're moving to the backside of that. Now, when you look at the vacancy rates across the country, again, you can see the Sun Belt impacted more than other markets. So, for example, you look at Austin, you have a 7.3% vacancy rate, Dallas-Fort Worth 6.7%, Nashville 6%, compared to, say, a Detroit, which is at 3.8%, or a Boston at 4.8%. So essentially, the Sun Belt has a vacancy rate somewhere around 7%. And the more traditional non-Sun Belt markets, maybe more in the 4 to 5% vacancy range. So that's where that's trending at the moment. And that's our 2026 forecast. When you look at the supply overhang and the impact on rent growth, again, your Class A in the Sun Belt, they're up a little bit on a year-over-year basis. So that's our forecast there. And when you look at the other property classes, the B and C, you can see that they're taking some hits there because of the cannibalization of their tenants. Compared to the non-Sunbelt markets, you're still running into some challenges. When I look at the rent growth across the country, and these are the 2026 forecasts, you have 3% up in some of the northern markets, and some of the markets across the Sun Belt are even dipping into negative territory, like Austin, which was really the poster child for overdevelopment in this cycle. Dallas-Fort Worth net rent growth forecast for the year 1.8%. You look over into Florida, you see ones and twos as well. Last year, Chicago and Cleveland had the strongest rent growth in the country at about 7%. So there's some real range here. This is not what we were seeing just a couple years ago. And it's not what I think we will be seeing a couple years from now. And that's part of the opportunity that I see in the marketplace. One of the other factors that is really important to the multifamily market is the spread between the payment on a median priced home compared to the average rent. And basically, home prices started shooting up in 21 and 22. They leveled off over the last year or so, and those payments came down a little bit as interest rates and mortgage rates started to come down a little bit. But nonetheless, the spread between the average rent and the payment on a median priced home is about $1,200. And it varies market to market. You look at Austin, it's a $2,400 per month spread. You look at Fort Lauderdale, it's $1,800 spread, and so on. Basically, a lot of people who would normally move out of an apartment and move into a house, go out and buy their first home, are not doing that. The median age of a first-time home buyer has increased to 40 years old. About 20 years ago, it was 30 years old. So there's a real barrier to entry, and a lot of people are just not going to make that jump. The renewal rate on leases has climbed up to 56% as a result, and that's going to retain that renter pool as we go forward. Now, when you look at the young adults living with family members. So because of the slowdown in job creation, there has been a rise in the young adult unemployment rate, and a lot more of the young people are moving in with family and living there. And that is not a permanent solution. That is something that people will do out of necessity while they're looking for work or while they're getting stabilized, and eventually they move out. If you look, it peaked last in 2020 during the pandemic. As we came out of the pandemic, those households unlocked and they started moving in into apartments and creating new households. And that is the normal trajectory. That's what we expect to happen once we kind of get past this period of uncertainty. Once job creation starts to reaccelerate, we expect that pent-up demand to start to unlock and drive significant absorption, kind of like what we saw over the last several years when we had that huge wave of housing demand that moved out into apartments. So when you start looking at the multifamily market, you see these vacancy rates that have come up. But once this pent-up demand is unlocked, we'll start to see those apartments fill up. And that's a big opportunity for investors, in my opinion, right now. So shifting gears, talking a little bit about multifamily investment, what's happening in sales and pricing, transaction activity. We hit a peak in 21 and 22 because the interest rates were so low, the rent growth was so strong, the demand for multifamily was going through the roof, and a lot of people were excited about that. A lot of capital came into the multifamily space, and we had record-setting transaction velocity, more deals than we'd ever seen before in the history of commercial real estate. But then as the interest rates shot up, the transaction activity dropped off. We saw a little bit of stumbling in the market. The vacancy rate started to creep up as we saw all that construction emerge. And we ran through a down cycle. Velocity dropped, and we have been picking up since 2023. So you can see there's a small gain in 24. 25 actually accelerated a little bit more. And the expectation is, based on the investors I'm talking to, that 2026 will see more transaction activity than we had before. Now, cap rates are a measurement of yield for investment in multifamily or other commercial real estate. I broke it out into primary markets, secondary markets, tertiary markets. Basically, a primary market is going to be a gateway market, population greater than 5 million or 6 million. Secondary market's kind of an in-between market that's in an expansion mode perhaps, and a tertiary market may be something smaller, population of 1 million or less in that metro. So you can see the cap rates, the yield on the smaller markets is much higher than the yield on the primary markets. That's because of the stability and safety perception of the primary markets relative to the smaller metros. It's also a measurement of the liquidity. You can sell an apartment building in Dallas much more easily than you can in Odessa, for example. You look at Class A and Class B, C cap rates. There's a little bit of a yield premium for your Class B and C properties, which are lower tier workforce housing. That means they're generating a stronger return compared to the brand new apartment buildings. Now, when you look across different markets, it's not a fixed number. Every asset is unique. And so they're going to trade at different cap rates. And what I've done here is I've shown a spread of the average cap rates. Basically, for example, Austin there at 4.9% as a bottom end. That's the bottom quartile of cap rates. Those are the 25% at the lowest level, 7.2% at the highest level for that 25% at the highest cap rate, and the average for the market is 5.5%. So there's a huge range of yields for different markets across the country based on investor activity, what the outlook is, and how they're pricing those assets. And overall, the national average cap rate is about 5.6% right now. So one of the things that we look at is the movement of cap rates over time. Historically speaking, cap rates have gone up 3 times. Once in the 90s, and that was when we were going through the savings and loan crisis and the REO, the distressed assets at that time. Then again in 08, 09, which Brad referenced as a recession that he navigated in the past. And then again in the last few years, while we've gone through that shock to the system caused by the interest rates. They don't last. They go up, the cap rates rise, the yields on the properties increase, and then at some point they reach a turning point and they start to recompress, at least historically speaking. That has happened the last 2 times, and I anticipate that will happen again. We're already seeing them flatten out and start to turn in some markets where they're starting to come down a little bit. So I think we may be right at the peak for those cap rates, or the trough of the cycle, if you will, and that creates and reiterates the opportunity that we have here right now. As those cap rates come down, that raises property values, and it generates a stronger and stronger return the more they compress over time. So the other factor that I think is really important is the cost of capital, right? Interest rates went up, and that slowed the market down. And these are the rates being charged roughly by different lender types. There's agency, which is Fannie Mae and Freddie Mac, which lends on multifamily. There's life companies, there's banks, there's commercial mortgage-backed securities, there's debt funds. And basically, if you compare where we are today to where we were in 2022, they're about the same. So the rates have gone up and they've recompressed back into a range which will allow you to have a interest rate, in some cases, not every case, where your interest rate on the money you borrow is lower than the cap rate, the yield on the real estate, and as a result, you have positive leverage. So basically, you borrow at 5%, you buy a property, it generates a 6% yield. you're making a 1% margin on the money you borrowed, which is one of the powers of leverage that you can get in commercial real estate. So right now, the cost of debt capital has come down, and that is going to support increased velocity and activity. Now, I am also seeing a lot of the large institutional investors raising a lot of capital right now. They're bringing the money in and they're committed into the real estate market. This is another reason I think there's going to be more money flowing into multifamily over the course of the next year. And when you look at the amount, really focusing on the right side here, the amount of capital raised by the major institutions in the United States, it started rising again. It hit a trough in 2024. 25, we saw it bump up, and I believe 26 will go even higher. The graph on the left is dry powder. It's undeployed commercial real estate capital. And so that is still at a very high, healthy level, basically on par with where we were in 2019, 2020, in terms of the amount of capital that's available and targeting commercial real estate. So I think 2026 is going to be an increasingly active year. I think the opportunities that are out there are pretty strong. I think the performance of the assets, it took a hit. We overdeveloped in a lot of markets. But once we burn through that supply overhang, there's nothing behind it. And those vacancy rates are going to start dropping very quickly, which will support increased rent growth, which will drive the returns on the assets. So as I wrap up here, these are the key drivers supporting multifamily investment, in my opinion. That pace of construction dropping off will support the contraction of vacancy and rising rent growth, as I just mentioned. The slowing pace of job creation will weigh on household formation and new tenant demand in 2026. But what's behind it is what's going to matter. The high cost of homeownership will retain renter households. Multifamily pricing has recalibrated from its peak. The cap rates have gone up. The prices have come down, and sometimes they're even below what it would cost to rebuild the property at this point. They're below replacement cost, and the debt financing rates are very accretive to investment at this point. So, Brad, that brings me to the end of my session.
Well, hey, John, thank you so much. That was really valuable. Let's everybody put in the chat. If you appreciated the information from John, let him know that by putting it in the chat.
Thank you.
Great data. And I appreciate it, John. There were some people asking about getting your slides and stuff like that. What I can say to everybody is you're going to get the recording so you can go through and rewatch the entire webinar, including the presentation and the slides. So, John, thank you so much. Really great to have you on.
My pleasure, Brad. Happy to partner with you again.
Yeah, thank you.
All righty.
All right.
Bye-bye.
So, Robert, you want to come on? Are you still here? Robert Helms.
Of course. I was hanging on every word there. That was really good stuff from John, as always. Prolific
Yeah.
guy.
So what are your key takeaways?
Well, a couple I think are the biggest things. Obviously, some concerns like increased vacancy. Shouldn't surprise too many folks about that, but we're seeing some of the reasons. John pointed out how many young people are still staying with mom and dad. So those are non-household formations, right? So that's that. I mean, you saw that graph. That makes a big difference. Now, how long do mom and dad want to have them around? Well, that varies, but I'm guessing that when it's possible for them to get their own place, then everyone's going to be for that. So that's pent up demand. But also, we're still in that overhang of the overbuilding. And what happened is a lot of folks saw the opportunity in multifamily and started projects. But there's rarely anybody keeping track of all these projects, but why they're still on the drawing board. Once they're a new housing start, once they have permits, John and crew pay attention. But until then, it's hard to figure out. So say a market is obviously 1,500 units shy. Well, if 5 different groups see it and they all add 1,000 units, now we've overbuilt, and that happened across the United States. And we're starting to see that wean out. I think another key takeaway for me, maybe the biggest takeaway, if you're new to investing, you might struggle a little bit with cap rates. And a cap rate is simply a return on the investment. It allows you to compare properties in different markets, different types of properties, even different types of investments. But John hit on something near the end about when cap rates are low, then we make more money selling property. So when cap rates are high, it's better to be a buyer. And I think there's an opportunity right now to buy when the cap rates are higher and then sell when they're lower, independent of all the other metrics. That's going to give some juice to your exit strategy.
Yeah. Any other, whether do you see personally and in your line of work and all the people that you have access to and what you're seeing in the market, do you see any additional number one headwinds or tailwinds?
Yeah, I see both those things. It's a great question. Most of the crowd I spend time with are pretty bullish on where things are going to be, but also see this short-term occupancy challenge, the rent increase challenge. But I'll tell you, that's when they get in, when those things are scaring others away. That's another big takeaway. There's been years where there's been 3 times as many people on the apartment forecast webinar, and those were difficult times to invest in because there was so much competition. Today, I think people are a little hesitant, which means those of us that aren't hesitant are going to get better deals. Yeah, apartments have come down, they're on sale, they're less expensive than they were. And so if your vision long term is 20 years from now, I'd like to control more doors, then the next couple of years could be an excellent time to get in.
Yeah. So, Robert, you see a lot of people investing in houses or maybe smaller, like small multifamily units. What do you think is keeping people from, going bigger and investing in bigger apartment buildings?
Yeah, that's such a good question. So many folks become accidental landlords. They couldn't sell their house, so they decided to keep it while they bought another house, and lo and behold, it became a great little rental. They didn't set out to be landlords, but that just happened. And then you get the folks who have a typical job doing what they do to live, thrive, and survive, and they get the bug. They go to a seminar like you did. They start listening to podcasts and like, man, we should get some real estate, and maybe they buy a single family house every 4 or 5 years. Nothing wrong with that. That's just a really slow way to get wealthy. To me, what holds people back is education. They think it's too hard. I mean, 200 units, how could I possibly do that? I'm just one person. And they get in this negative self-talk loop that, well, that's only for the big guys. But in reality, and you know this because you lived it, it doesn't take that, right? Your first 2 buildings you bought on your own. Now you had lived below your means, saved some money, worked hard, had a good paying job, all those things, and then you prudently deployed that. But if you were dependent on your own capital, you'd probably own just 10 buildings now instead of having done the volume that you've done, because it actually gets easier to invest in bigger stuff. People don't understand this. They think it's too hard, it's too many units. It gets easier because there's more professionals involved. You buy a 200 unit apartment building, your lender's going to insist that you have reputable third party management who are going to do a good job. They're also going to make sure your debt coverage ratio is strong. So you're not going to be put in a position by your lender to fail. Not that you can't fail, but you just have more people rowing in the same direction. So I think, I'm a big fan of your Rat Race to Retirement event, having been several times. And the first time I went, I'm like, wow, okay, I'd met you, I'd seen you present a couple of times. And it was obvious you had not what we call head knowledge, but seat knowledge, time in the saddle. But when I saw you do those 2 days, 16 hours of teaching, I'm like, wow, this guy really does know his stuff. But that's what you would expect after over 2 decades. So I think for folks that are starting out, you want to be encouraged that it is possible. One of my favorite things at your events, Brad, is proof of concept. All around you are people that have been doing it. You have students that have been doing this for 2 years, 5 years, 10 years, 15 years. So that evidence of success is around you. Everyone knows you can, get a single family house and put a tenant in it. Not everyone understands how apartments work. It's really the same thing. It's just, there's so many better reasons to be in apartments in terms of economies of scale and efficiency and better vendors and less headache and less work for you to personally do.
Yeah. So, hey, Robert, thank you so much. Any other insights or comments before I come back on and finish up?
No, I just think that folks are sitting in the right place at the right time. I used to teach appraisal and real estate practices at the college level, and whenever my class size was small, that was the best time to get into real estate. Whenever the class size was big, it's like, oh, we're overdone here. I think there's a great little window here. I don't know if it's a year or 18 months. The smartest people I know in multifamily are buying. I'll just leave it at that. But appreciate being on. Congratulations on getting John to join us. That was awesome. And I know you'll have some things to add. Can't wait to hear you about your top 10 markets.
I do. Are you going to stick on or do you need to jump off?
I'm going to stay on for a little bit.
All right. Well, if you stay on, I'll bring you back at the end.
Right on.
All right. So I'd like to get your comments on, on what I have to say. So, hey, one thing I want to share with everybody, okay, is how important it is to be in the right room with the right people at the right time. So I've known John Chang for maybe not quite 10 years, but more than 5. And, part of how I know him is that between my own transactions and those of my students in the Dallas area, we've done tons of deals with Marcus and Millichap, and not just in Dallas, but many, many markets. And so every year there's a conference, an annual conference hosted by the National Multifamily Housing Council. And what it is, it's an annual event in January, and it's basically the who's who of apartment investing. The top brokers are there, the top lenders are there, the top industry professionals, service providers, and investors. So did I feel like going this year? No, I did not feel like going. In fact, I never feel like going. But, sometimes you got to do what you don't feel like doing that is going to pay off. So I wound up the last week in Las Vegas, the last week in January in Las Vegas. And of course, I have several meetings with different Marcus and Millichap brokerage teams across the country to find out what's going on in their markets. And also met with many other brokerages. I met with Marcus and Millichap, CBRE, Newmark Knight Frank, MMG, Northmark, Franklin Street. I mean, the list, Lumint. I mean, the list goes on and on and on. And so I am meeting with them in some of the top markets that I invest in, and that I know that my clients, also known as students, invest in, because I'm committed to the industry. I want to know what's going on. I want to know how brokers are underwriting deals in their markets. I want to know what pricing is, what cap rates are, what's happening in A, B, and C class, what's happening with concessions, rent growth, negative rent growth, what's happening with renewals, and are renewals up or renewals down. And so the way you do that is you show up and you put yourself in the room. Okay. And I was there and I had lots and lots of meetings. And so one of the things I do is, this is a free event, but many of I have a paid community, and I share that information. I'm going to share as much with you tonight as I can, but we run out of time. But I share that information with my paid community. But the whole point about John Chang is how he showed up to this event is before January 28th, he was not on this event. It was just Robert Helms and I. And, I looked at the Marcus reports, the Cushman reports, the Berkadia reports, the CoStar reports. And then I take my own market knowledge because me and my coaches, we're helping people all over the country. And so I do this annual forecast every single year. But this may have been the second time I've had John on it. So I'm in Vegas and I'm meeting with the Marcus guys. And then John Chang comes into one of my meetings and listens in. And then he stays after. And then we get to talking and we get to chatting. And then I just said, hey, what do you do on February 4th? And he's like, I don't know. And why? And I said, well, I'd love to have you on the forecast. And so anyway, long and short story is he's here. And so what I want to let you know is you got to be in the right rooms. Okay. And you got to put yourself out there. And at this annual event, the brokers have listings, they have deals. So if you want deal flow, you're not going to get the deals by staying home, because the other investors in your market are there and they're in front of the brokers. You've heard the term out of sight, out of mind. Well, if they're in front of the brokers, if they're at the cocktail parties, the networking events, the hospitality suites, and you're not, it's not that you're not going to get the deals, but the other guys and gals might be getting them first, or they might be getting that close look because they just met with these brokers and they're talking about deals in their market. Okay. So you got to be in the right rooms. You got to get in front of the right people. You got to be at the top of mind of the people you want to do business with. And then you got to ask for the order, meaning like I asked John to be at this event, and I could have not asked him. And then for sure he wouldn't have been on the event. Or I could ask him and maybe he was busy, or maybe he didn't want to be on. But that's the risk that I was willing to take. So the whole point is you got to be in the right rooms. You got to have intention. You got to have clarity. You got to know, like, what is it that I want to get out of this experience, this event, this conference, this meeting, and ask for the order. You got to ask for the order. So I just wanted to share that. So my segment here is going to be about another 15 to 20 minutes. It's not going to be that long. So I said we'd finish in 75 to 90 minutes. We started at 5 minutes after the top of the hour. We're 55 minutes in, and we'll finish within that 75 to 90 minute time frame, well within that time frame. So, and Robert Helms is going to stick around till the end, and we'll see. Maybe we'll even do some Q&A if some of you are still around. So we'll see. I'm going to go ahead and share my slides. So let me do that. And the slide I want to share again is, rather than waiting till the end, I want to share this with you all now. And I'm not sure why that prompter is there. That's kind of weird. I don't like it there. Oh, maybe it's not sharing. Let's see. It's sharing. There, and there. Okay, I don't know what's going on. It looks like, could you guys see, Ivy, could you see the prompter in the lower left corner?
Nope, I just see your slide. Looks
okay,
good.
Great. Because on my screen, I can see like this black box, which is really weird, but I'm glad you can't see it. So rather than waiting till the end, so just so you know, at the end, there's nothing else I'm pitching or promoting or offering. Okay. So I want to make sure that everybody knows about this event. And, I've been doing this event since 2013. I've been doing it 2 or 3 times a year. And so what I'm going to do in Dallas, and this time I'm going to do it 100% free if you apply and you are approved. Okay. And I'm going to walk you through the entire sequence. And I'm going to show you maybe at the end, if we have time, the 20-step or 18-step sequence. But it starts with like understanding your why and getting your investment criteria and selecting your markets and understanding the business model and then finding deals. And how do we talk to brokers and then analyzing the deals, quick and dirty, and a quick and dirty way, a quick and simple way to analyze, and then a thorough discounted 5-year cash flow analysis way to analyze deals. And then how do we do the due diligence and the inspections? And then how do we raise the money and get the debt? And then how do we close the deals? And then how do we manage them and the KPIs? And what are the rules of thumb for different property sizes and property management and insurance and tax returns and cost segregation studies? So I'm going to cover all of that. And then I'm going to talk about different exiting, selling, refinancing, remodifications. I'm going to talk about how dealing with challenges Hopefully some of those challenges are behind us, but there's always going to be some challenges in the business. So we'd be talking about challenges, and exiting deals. And so we're going to cover all that and more. And I'm also going to put you on a bus for a half a day. And we're going to look at properties in Dallas that I own and some of my local Dallas students own. So not only will you learn from the field, you're going to learn by seeing deals in progress. So again, your seat is on me, your lunch is on me, the education's on me, but you got to apply. And after you apply, within 24 hours, me and my team review all the applications. I personally review each and every one of them, but you got to confirm your seat. So you're going to get email, you're going to get automation, in today's day and time, we automate emails and text messages and confirm by pressing 1, but we're also going to physically call you with a human to make sure that you're coming, because we're going to have a seat for you in the room, your lunch, and on the bus. Okay. So if you do apply and you're approved, make sure that you pick up the phone, to call us when call us back so that we have a seat for you. So I'm going to go ahead and finish now and wrap it all together. This is another view from Berkadia. Okay. And there's no way in the amount of time I have tonight that I'm going to share all the research from Marcus and Millichap, Berkadia, Cushman, CoStar, but I want to give you some more big picture. So, Berkadia is also showing this is national, not any specific market, is that we'll be at around 95% occupied nationally. Now, John did a great job distinguishing between the Sun Belt markets, which is basically the Southwest, Texas, the Southeast, and the Carolinas, and the non-Sun Belt markets. And what happened in the Sun Belt markets is they were always the darling markets, but in 23, 24, and 25, they were the markets that got hit with all the oversupply. And some of those Sun Belt markets in Texas and Florida got hit with really high insurance increases because of all the storms, and so it created some challenges. So the Sun Belt was the fastest growing area, and it was also probably the one that suffered the most over the last few years. But to me, and one of the things I'm going to talk about is one of the things that I'm seeing in my research is the Sun Belt is posed for a recovery. Now, that doesn't mean that we should be aggressive at all. We got to be conservative in 2026. Like, one of the things I learned from the conference in Vegas is in a lot of these markets, we're underwriting like 0 rent growth for 2 years. Now, this isn't a case of like organic rent growth. There are still some cases where if we're buying a deal that's undermanaged and only 70% occupied and being managed by an out-of-state owner that's completely hands-off, and all the other properties are $150 or $200 higher, well, then of course you could budget in raising rents. Okay, that's not what I'm talking about. I'm talking about the standard 3% rent growth. Like, rents never go up 3% every year. Sometimes it's 0, 0, 0, and then 7%. Okay, so how do you forecast that? How do you underwrite that? So, right now what I'm hearing is, in some of these Sun Belt markets, we should be the first year or even the first 2 years really conservative on rents, but then getting back to, the long-term averages of 2 to 4%. And that's what we're seeing because of the data that John presented. We're seeing massive decreases in starts. We're seeing there's just not a lot of projects being built. Okay, so even though we have a slightly growing economy and we have all the millennials living at home with their parents, or the 25-year-olds living at home with their parents, there's still a relative shortage, especially of affordable housing. Okay, so Berkadia is also showing that rents on average nationally are going up 2.5% this year. And the good news is nationally, rents are only taking up less than 25% of somebody's take-home pay. That's the rent share of the consumer's wallet. Okay. And that's down, okay, 80 basis points. And so, in spite of what you may hear, rent is taking up less of our paychecks in 2026 than they did in 2025. Okay. So that's good for the tenants because the tenants can afford to live there and to pay the rent. So again, just some other charts and graphs. On the left, we can see effective rent continues to move up, and we see occupancy staying flat. Now, again, this is national. Okay. The one thing I got to tell some of you, and some of you are in my mentoring and mastermind program. Okay. And you need to hear this. We can't just look at national data, and we can't just look at data in your city or area. You can't just look at Las Vegas or Phoenix, or Dallas or Fort Worth or Tampa. You got to know what's happening in your submarket, in your intersection. Like, here's an example. Like, we can look at DFW and see trends, and we can look at Fort Worth, and we can even look at Arlington, Texas. Okay. But there's thousands, tens of thousands of apartment units in Arlington, Texas. So what's happening in Arlington may not be representative of what's happening on this intersection. So if I'm underwriting this deal here, and there's 8 other properties nearby, and one of them is a foreclosure being sold at 60 cents on the dollar for below loan value, that one property, let's say there's 400 units that's being sold for below loan value, and the bank took it back from the owner. Well, they're slashing rents to fill it up. They're offering concessions. And so that one property could be impacting our property, your property, my property. And that's not going to show up on a Arlington city report. Okay. So it's more important than ever that you can look at these industry reports and those in your market reports on a macro level to figure out, hey, in general, where are the fundamentals leaning toward great markets to look into? But you got to discover what's going on in your neck of the woods. Okay. Hopefully everybody's getting that point. Super, super important. So again, this is Berkadia showing rent, occupancy, absorption, and deliveries. Okay. Employment is another driver. Berkadia is forecasting that nationally our employment is growing. It's slowly, but it's growing positively. And it's showing unemployment going down. And that actually contradicts some of the other reports that I showed where it shows unemployment going up a little bit. So as with anything, if I look at 6 different reports, sometimes I'm going to get 6 different answers pointing in different directions. And so what I try to do, again, is just to make the most sense of it all. I saw Greg Butcher on, one of my former students. And, Greg, you were shocked that they were showing a high occupancy rate in Phoenix. And you commented in the chat like, hey, the local brokers are showing higher vacancy. And when you did that, I just went to my other machine here and I pulled up the Berkadia report for Phoenix as well. And it showed, I'll just show you what, read out loud, like what Berkadia says for Phoenix. I'm looking at Berkadia Phoenix right here. It says occupancy rate at the end of 2026 is projected to be 93.4%. Rents in Phoenix are projected to be up 1.3% year over year. That's news to me too. I mean, I'm personally not that active in Phoenix, but I keep hearing that Phoenix is a lot softer than that. But then we got not only Marcus and Millichap, but Berkadia showing different numbers. So you got to do your research, okay? And you got to know what's going on in your neck of the woods. That's really, really important. That's one of my biggest takeaways right now. Okay. This is also from Marcus and Millichap, but I didn't see it in John's report. So we could see the orange bar is the national average cap rate since 2010. And we can see how it went down to a low of, say close to 4.5% nationally in 2022. And it's back up to around 6% in all markets and in all asset classes. And we could also see how price per unit peaked and now it came down and now it's kind of stabilized. And, you know, what are cap rates trading at right now? So right now we're seeing cap rates at a low of somewhere around 4.8% and a high of somewhere around 7.4% with an average cap rate around 6. Okay. So that's what we're seeing nationally. This is another chart that I got from Marcus that John didn't have in his charts that you guys might want to pay attention to. Is now cap rates are something that we can only get after the fact. So we're sitting here February 26, and you can see it says the Q3 2025 cap rate. Well, why is that? Why can't we get February 2026 cap rate? Well, the reason is cap rate is what is the market, what is an investor in the market willing to pay for an income stream? Okay, so here's how cap rate's determined. Somebody's looking at a deal, an apartment deal, and there's an NOI, right? There's an NOI from that apartment building. And then they buy the deal, and there's the price paid for that NOI, right? And so every quarter or every month or every quarter, we look backwards and we see, okay, well, here's the NOI of the deal. Here's the price that was paid for the deal. So that's the cap rate. Okay, the cap rate is NOI and price, and that determines the cap rate. It's the price somebody's willing to pay to get a certain income stream. Okay, I hear all these definitions of cap rate. Oh, it's the unleveraged rate of return and all that kind of stuff. And most people are like, well, what does that really mean? Well, what it means is here's the NOI and what is an investor willing to pay? It might not be what you're willing to pay, but what is a arm's length investor willing to pay? What is the market willing to pay for that NOI? That's the cap rate. Okay. So you can see here, some of these markets are high cap rates like Detroit, Cleveland, you know, Milwaukee, and cap rate is an indication of return. So somebody might look and say, wow, I'm going to be, you know, making offers only in Detroit, Milwaukee, and Cleveland. Well, the problem with that is Detroit, Milwaukee, and Cleveland, on average, they have negative population growth, negative job growth. You know, they're not the best environments. That's why the cap rate is higher. You know, and you know, a higher cap rate also indicates higher risk. You guys got to know that. So what I try to look at is like, I don't want to be in the lowest cap rate markets. So some of these that are dark green, you know, I don't necessarily want to be there. And I'll say this tongue in cheek. I mean, who wants to invest in California anyway, right? It doesn't meet any of my criteria. But I like a lot of these yellow circles and the orange circles. They're like moderate cap rates. And then, you know, later on tonight, in just a few minutes, I'm going to talk about what makes a good market. And part of that is, you know, you don't want to be necessarily in the highest cap rate market, but you don't necessarily want to be in the lowest. I like these moderate, these middle range cap rate markets. And then I look at like, are they business friendly and landlord friendly? You know, can we evict somebody for non-payment of rent in a reasonable amount of time? I saw some of the chats about New York or whatever, and you can't evict people. Well, I want to be in a city or state that is going to give me a fair chance to succeed, which means if they use my product and they don't pay, that it doesn't take me forever to get them out, right? I want to be in an area with the population is growing and jobs are being created, and it's expensive for a working class family to buy a house. And so they're going to be more likely to be renters. Okay. So I look at cap rate and I look at vacancy, but those aren't the only things I look at. Okay. So renewals, John mentioned this, but he didn't show the chart. Renewals are the highest they've ever been, except right at the peak in 2022. And so what we're seeing now as operators is we're seeing in some properties, like more than 60% of our tenants are renewing their leases. Okay, so we might be offering concessions on new leases, right? Because the property across the street might be in a foreclosure and they're cutting rents and all that kind of stuff. But on renewals, it's hard for us to push rents right now on renewals in that kind of situation, but we're getting renewals. People don't want to move. Most even working class people, they're not going to move for a $25, savings to go somewhere else. Like, it's the time, the cost, the inconvenience of moving. Okay. So renewals are really high. And a lot of things we're focused on in operations right now are renewals. John said it. So we have a new appointment for the chair. And this is why Trump has appointed him probably, but he's really bullish on lowering rates, and believes that lowering rates is good for our economy, good for housing, good for business, good to stimulate the economy. So that's positive, and that's probably something that we could expect. And look, there's a lot that could go wrong. There's a lot that went wrong before. And there's a lot that could go wrong. Just take a look at it. Like, I don't need to read all this stuff. And some of them are like, in red, that increase severity or decrease. There's geopolitical events, terrorist attacks, oil prices, banking system, AI, a misstep in the Fed, crypto crashing, insurance markets. It's funny, climate change is like all the way down at the bottom in terms of likelihood of risk and economic severity of risk. But, 4 or 5 years ago, climate change was a big deal, and I'm not sure what that really means. Does that mean it wasn't a big deal? Or does it mean it is a big deal and people aren't just paying attention to it? I have personal opinions about it, but I'm not, I don't know if my personal opinions are right or if they don't matter. Okay. So there's a lot that could go wrong. And intelligent investors need to know that, and this isn't just with multifamily. It's with anything. It's with the world. It's with your financial situation. It's economic stability in anything. You could have money in the bank and some of these things could hurt you. You could have money in a mattress and some of these things could hurt you. So this is another regional snapshot. Okay. I can't remember where I got this slide, but we could see highlights. We have the Midwest, has only a 3.9 vacancy. The Midwest did well relative to the Sun Belt over the last few years. Now, I don't like markets like Chicago because it's not landlord and business friendly. But in the Midwest, I like Columbus. I like Indianapolis. I personally like Minnesota. Like, it has a bad name right now with ICE, but I have a property there in a very conservative area outside of Minneapolis, and it's doing really well. Then we look at the mountain range. Again, vacancy is hovering around 5%. Salt Lake City is a strong market. But it says right here, Phoenix accounts for more than half of all the apartments absorbed, and it's considered in the mountain range, the mountain area. Then the Northeast. I don't even look in the Northeast. It's just not landlord and business friendly. Northeast is generally, I'm from Pittsburgh, but it's like not as landlord and business friendly. And we just tend to have a lot of, less jobs and migration and population growth there. So I don't really consider that a market that I'm interested in, and neither do I consider the West. So if I'm looking at this, I just put a big X through the Northeast. I put an X through the West. And most of my focus is and has been on Texas. The Southeast, Southeast Florida right now. In this Marcus and Millichap report, Fort Lauderdale is the #1 market in the country for apartment performance. Miami is #3 and West Palm Beach is #5. So I'll spill the beans. My top market, #1 top market in the US for apartment performance is going to be Southeast Florida. Okay. Number one. Now I know someone's going to say, well, what about insurance? Well, that's baked in there. yeah, we got to deal with insurance, but insurance is coming down right now everywhere. It's coming down in Florida. It's coming down in Texas. It spiked up because a lot of named storms, but it's coming back down. Okay. So Texas, the markets in Texas that I call out, Dallas is always strong. Houston is making a run for a top 10 market, and San Antonio. I mean, I just don't see Austin being a market that I'm personally interested in. It's overpriced and oversupplied. And then when we look at the Southeast, besides Florida, Atlanta and Charlotte are doing really well. Like, these are going to be in my top markets. Okay. So that's just some regional insights. I didn't read everything on there, and hopefully you took a screenshot of it or read through it. And so putting it all together, this is kind of my summary. So, all this uncertainty, the tariffs, the invasion of Greenland, and now it's not, the Colombia narco terrorist is now in the White House being friends with Trump. Like, this is kind of the new normal. Like, it's crazy, but it's the new normal. And I would just say, get used to it. It's really interesting times. And so in spite of all that, our economy is still growing, although moderately. We have AI to consider, like, how is AI really going to impact jobs? And what's going to happen with ICE and immigration? It's still TBD. It doesn't seem like the tariffs are having a huge impact on inflation. And John showed a chart around that, a graph. And it seems like we're getting a lot of money from tariffs, honestly. So it seems like it could be working. John mentioned this, but debt is readily available. Okay. Unlike 2011 and 2012, I was investing in 2011 and 2012, and debt was very hard to get. And it's not hard to get right now. And the GSAs, which are the government sponsored agencies, Fannie Mae and Freddie Mac, they have a charter to do 20% more, issue 20% more debt in 2026 than they did in 2025. So Fannie and Freddie are actively looking to invest, and they love workforce housing, the B and the C class. They love the B and the C class. I already talked about this, but the Sun Belt is poised for recovery because of demographics, because of landlord and business friendly, because that's where the jobs are being created. That's where people were moving. And generally speaking, like the Sun Belt markets, especially like Texas and Florida, are very low, and they have no state income tax, and very landlord and business friendly. So I talked about renewals being at an all-time high. And here's the other thing. More and more deals are penciling out. Like, even in 2023, man, it was hard to get deals to pencil out. Like, interest rates rose so fast, 16 times in 12 months, or was it 12 times in 16 months? And as that was going, like, the lenders didn't know how to price their debt. Sellers didn't know, like, there was so much uncertainty that, like, transaction volume almost stopped to a halt. And now deals are penciling out, and they're penciling out to the buyer's advantage, because the sellers that had to sell in 2023, most of them were able to finagle their way through a loan extension. And then they were able to finagle their way again for a loan extension. And now these lenders are getting tired of, the continuing to kick the can down the road. And so what we're seeing, little by little, gradually by gradually, rates haven't come down as fast as we thought. They are going to come down this year, especially with the new Fed chairman, but they're not going to come down as fast as we all wanted. And even when the rates go down, the impact on the 10-year Treasury isn't quite clear. Okay, so I think we're going to have lower borrowing rates, but not like dramatically lowering borrowing rates. Some people are like, oh, with the new Fed chairman, we're going to be at 4% again. I don't know if we're going to be at 4% interest rates. I mean, I would love if we were at 4% interest rates, but I wouldn't count on it, at least not in 2026. So we're seeing more deals pencil out, but they're penciling to the advantage of the buyer, not the seller. Like, it is definitely a buyer's market. Okay. Now, on the equity side, John showed us that the institutions they're raising billions of dollars and they have all this dry powder. But on the retail side, let me share with you, it's different. And why is it different? Is that so many people that were in the business in 21, 22, they got into deals, and some of these deals underperformed. And so if you're a capital raiser, or if you're trying to put a deal together and raise money, I mean, we got to be sensitive to that. I mean, I'm in that boat. I got deals that didn't perform well either with my own investor money, but I see that I have the advantage of being in the business 24 years. And even though I might have a deal over here that's not hitting the numbers, I see the buying opportunity. And it's kind of like this concept called dollar cost averaging, so I see the opportunity. But if you're a GP and you're trying to raise money and you're going to the same investor group that you did a deal with in 2022, where the distributions have been halted, or maybe you did a capital call or worse, like they're not going to invest with you. Okay. So you need to find new investors. You need to find new people that see the future. Okay. You need to find people that see the future. And so if you're going to your same investor database, and I'm talking to the experienced syndicators now, it's going to be harder for you to raise money. It's going to be harder. And if you're a GP in these deals, you got to work through these deals and you got to work through these challenges to the best of your ability. But I also want everybody to see, everybody here, whether you're brand new to apartments, you have a great opportunity. If you've been in it for 4 or 5 years, you might think, man, this has been a few hard years. Am I ready to get into this again? If you've been in it like me for 20 years plus or 10 years, you know that it was good. And it was just a 2-year blip. So you might be eager again. Okay. And so you got to know like who you're talking to when you're trying to raise money. Okay. So this is a slide that I show a lot, and I covered it already in a lot of different ways. But just to go through it really quickly, pricing is down. We're near the bottom of a cycle. We talked about the starts being near a 10-year low. We talked about the demand for housing, and the affordability of buying a home is harder and harder for a working class family. But what I want to accent here is it's a buyer's market. There are deals that have been over leveraged. We didn't see it that way at the time, or whoever was buying those deals. But based on what happened with COVID and the printing of money and the rising of interest rates, there's a lot of deals that, like, say, for example, if someone bought a deal for $10 million and had a $7 million loan, some of these deals now are selling for loan value. Like if someone bought a deal for 10 million in 2022, it might only be worth 6, 7, or 8 million now because of how things changed. Okay, so that's not good for that buyer group, but that's good for the buyer right now. It's not good for the group that bought it 4 years ago, but it's good for the buyer buying it right now. Okay, so the people that are buying right now, they see these opportunities. Okay, and then we had the big, beautiful bill that was passed. And what that does is it brings back 100% bonus depreciation. So it makes apartments, from a tax perspective, it makes apartments the greatest investment possible for taxes. Okay, so for every dollar you invest in apartment buildings right now, and it depends on the deal and the debt and the land value to building value, but you're getting about, like, if you invest $100,000 in the deal, you'll have about a $60,000 loss on your K1 for the year you invest. So before I finish, I want to show you a real deal that one of my coaching students is buying, and it's 109 units in Irving, Texas, and it hit the market at 11.5 million. Back in 2022, this deal would have sold for 13. There would be 40 buyer groups from all over the country and outside of the country bidding up the price. Everybody wanted to be in Dallas. Everyone wanted to buy apartments. Interest rates were 3%. And the deal would have penciled out. Like if we would have looked at the underwriting, it would have penciled out. Okay. Except interest rates rose from 3% to 8%, and insurance sometimes doubled or even tripled. And so, it didn't work out. But now that deal that was selling for 11.5 million, one of my mentoring students got it under contract for 7 million. So this is the kind of opportunity that we're seeing right now. And we're seeing it all over the place. We're seeing it all over the place. We're seeing it in Texas. We're seeing it in Florida. We're seeing it in Ohio. We're seeing it in Indianapolis. We're seeing it in Tennessee. We're seeing it in Arizona. We're seeing it in Las Vegas. We're seeing it everywhere. Okay. So my last topic is what makes a good market. Okay. At the macro level, you got to be in a market that's landlord and business friendly. I look at job growth, population growth, affordability gap. You don't want to be in a market that has too much oversupply. That's a bad thing. And you want to be in a market, it can be a tertiary market. I mean, I have a property in Abilene, Texas, which is a tertiary market, but it's got a diversified economy, and it's my best performing property right now in Abilene, Texas, of all places. So one of the things I want to tell you all is that go to the tertiary markets and the secondary markets, and you may find value there. You may find your opportunity there. So I'm going to show you some of the top markets right now, but don't just stay in those bigger primary areas. Go to the secondary and tertiary markets around these markets. So these are my top areas for 2026 in order. Okay, in order. So we have Southeast Florida. I already mentioned to you that in the Marcus report, Fort Lauderdale is number 1, Miami is 3, and West Palm Beach is number 5. Okay, number 2 is the Raleigh and Charlotte areas of North Carolina. Number 3, it's just hard to pick. I mean, Houston's top 10, Dallas, San Antonio, they're all in the low top 10s, mid-teens in the Marcus report. I've looked at the other reports. Again, you gotta look in the individual submarkets on what's going on. Okay, we can't just say, oh, well, rent growth is flat. It's like, well, you may have to offer concessions at your property, and you may be able to do value add upgrades at your property. It depends on what's happening at the property and with the comps. Okay, it's really, really, really critical. Tampa, St. Pete, I have Columbus, Ohio. Look, I bought a deal in 2015 in Columbus, Ohio, and sold it in 25 because my 10-year loan was due, and we 4x'd our money. I mean, we got to be looking in Columbus, and all the data supports Columbus, Ohio. It's the best market in the Midwest. And then you have Indianapolis, which is a good market in the Midwest too. Very landlord and business friendly. Atlanta is a strong market. It suffered. Atlanta was not in my top 10 list for the last 2 years for a variety of reasons, but it's back. And again, Phoenix, it's got hit hard in Vegas, but I think they're poised for a recovery based on demographics. So that's my take on things. And I'm not going to go through the Sumrok sequence here. I think we're running out of time. I just want to go back to my event one more time here. For those of you that want to come to Rat Race in Dallas as my complimentary guest, you just need to take a picture of that QR code, fill out the application. You'll likely be approved. Look, who's not approved? If you have no job, no money, no credit, and you put on your goals that you're going to buy 1,000 units in the first year, you're not going to be approved because that's not a realistic goal. This is not a get rich quick scheme. Okay, I'm looking for people with a decent job, decent income, some net worth, so you could actually invest into a deal, and somebody that wants to be trained by me, honestly. Like, I'm going to be walking you through the steps to find deals, analyze deals, fund deals, close deals, and manage deals and exit deals, and I'm going to take you out and look at properties. So that it's not a dog and pony show. I have no celebrity speakers. I have no DJ. It's going to be a training event, like a workshop, and it's going to be for committed people that want to learn. Okay, so if that sounds like you, I'd love to have you there. So fill out the application. And thank you everybody for staying. So many of you are still here. Robert, I want to bring you back up and see if you have any comments on anything that I said.
A lot of good stuff there, Brad. You packed a ton into a fairly short period of time. I think people, want to know the markets, but even more so as you're talking about markets, those do change. Your list changes every year. So you got to stay plugged in. And I think we regret the things in life that we don't do a lot more than we regret the things we do. So I would always err on the side of action. And I know the slide that you often show says 1 year from today, you'll wish you had started now. And I feel that that's where we are. It's a great place. Not everything is solved. There are headwinds. That's why there's opportunity. If it was all tailwinds, the pretty people would have already done it by now. So I would just encourage folks, if you made it this far, you're serious about it, come check out Brad's Rat Race. It's an awesome event. And I wish you luck in your investing. Thanks for having me tonight, Brad.
Yeah, thank you, Robert. Thank you so much. And it was great having you on. Great to, talk to you after John's presentation and hear what you think. And you shared some valuable insights as you always do. So, hey, everybody, if you enjoyed Robert being on tonight, let him know it by putting it in the chat. And make sure you listen to his podcast.
We're just entering our 30th year of broadcast at the Real Estate Guys radio show. So check us out.
That is crazy. 30
Crazy.
years. That's crazy. Well, thank you, Robert. And hey, everybody, thank you. It's 41 minutes after the hour. We started at 5 minutes after the hour, over an hour ago. And so we're running up we're past 90 minutes. I got a little excited. I got carried away. I thought my portion was only going to be 20 minutes after John Chang, and it turned into be 35 minutes. I want to say I'm sorry, but I also want to say that I can't help myself. Like I get lost in the moment. I feel like I have a lot of information that's valuable to you. And I never, ever, ever, ever let a teaching lesson, an agenda or a time limit get in the way of a good experience. And so for the hundreds of you that are still here, hopefully you had a good experience. And, I apologize for going a little late. All right. Well, I hope to see who's going to come to the Rat Race event. Let me see in the chat who is applying to come to Dallas. If you're coming to Dallas, type in R2R. Just type in R2R. Or yeah, I see me. Type in R2R, R2R, R2R. Who's coming to R2R? And what R2R stands for is Rat Race to Retirement. And the reason I call it that event is I used to be in the corporate rat race for 14 years, and I got out of the rat race within 3 years of investing in apartments. And so this is a personal event for me. Okay. I say it's my story about how I got out of the rat race by investing in apartments, but it's not my story. It could be your story, and it's been other people's story. So whether you're in a corporate rat race, or maybe you have a small business owner and you're just spinning your wheels, or maybe you love your job, but you just want to earn more income and have more freedom of time. And maybe you love your job, but you just need more freedom and you want to travel more. You want to buy a dream home and you want more income and you want to pay less tax. Okay. You don't have to want to retire in order to come to the event, but maybe you'll retire from a life that you're in to a life that you want to be. Okay. So that's why I call it Rat Race to Retirement. And I'm going to teach you what I have learned in 24 years, the good, the bad, and the ugly. But I'm going to teach you how to do this business, and I'm going to teach you how the business right. Okay. It's not a hype event, no dancing, no massages, no shoulder rubs. I mean, I'm not saying we can't do that it's not part of the formal event. So I am high energy. I'm passionate. It's not just a traditional classroom event, but we'll be sitting and we'll be standing and we'll be learning and we'll be workshopping and we'll be sharing our answers and debriefing with each other, and we'll be doing Q&A. And at the end of 16 hours, you're going to come out knowing a lot of the fundamentals that you need to be successful in this business. I promise you that. All right. Thank you, everybody. And good night. I'll see you soon.